All right. I greet all of you. Welcome, guys. Welcome to the third lesson, the lecture number 3, financial statements and accounting equation. My LinkedIn, you can always scan and check me out. All right, the lesson overview: accounting concepts and accounting equation, effect of business transactions on accounting equation, and financial statements preparation. So those are the 3 things that you should be able to do at the end, those 3 things. All right, so we are going to go back now to those accounting concepts and conventions. They can also call them accounting principles. So there's the one they call going concern concept. This one assumes that an entity will continue in operational existence for the foreseeable future. You know, a business is a going concern. We don't start a business saying it will close after 1-2 months. No, it's a going concern. And then we have the accruals concept. It's concerned with the allocating of expenses and income to the periods to which they relate. And then we have the realization concept. It states that profits shall be treated as realized only when realized in the form of either cash or other assets. The ultimate cash realization of which can be assessed with reasonable certainty. Then we have the matching concept. It assumes that the measurement of profit costs should be set against the revenue that they generate at the time when this arises. So it has to match. And then we have the entity concept, also called the accounting entity or a business entity concept. A business is considered as a separate entity, distinct from the person who owns it. That's why you see when you get a company, you have to register the company. It gets its own registration number. That's like its national ID. It's a person. People can sue it in court on its own, like that. That's the business entity concept. That a company or a business is a person on its own, and it's treated like that by the law. And then we have the time interval concept, which is also called the time period concept. It refers to the practice of dividing the life of an entity into discrete periods for the purpose of preparing financial statements. Like most companies, they do quarterly statements, like every 4 months, like something like that. So that's the time period concept. And most companies, they do their financial year 365 days, like one full year. All right. And then we have the historical cost concept. All the transactions in an entity's financial statement reflect the actual cost price billed or revenue charged for the items. Like these things need to have, those blockchain records, like the receipts and bills and, invoices. You don't just guess a number in the financial statements. It needs to be backed by source documents. And then we have now what we call the money measurement concept. The money measurement concept says that accounting records, it records only those transactions that can be expressed in terms of money. You understand now, guys? From the previous lecture or the one before, I told you about this. It's about profit money. If the events or transactions cannot be expressed in monetary value, they are not recorded in the books of accounts. That's the money measurement concept. And then we have the dual aspect concept or duality concept. It assumes that every transaction has 2 aspects. Every transaction affects 2 accounts in a set of financial statements in such a manner that assets would always equal liabilities plus owner's equity. That's the accounting equation. We'll touch on it later on. And then we have now what we call, like with this duality concept, it just means debit credit. For every debit entry, there is a corresponding credit entry. That's the duality concept there. The prudence concept now, it assumes that financial statements have been prepared on a prudent basis. Only profits realized at the date of the financial year end shall be included in the financial statement. And all liabilities and losses which have arisen or are likely to arise in respect of the financial year shall also be taken into account. That's the prudence concept. And then we have what they call the substance over form concept. It assumes that when accounting for transactions, the preparer or bookkeeper should look at the economic substance of a transaction, not its legal form. So it's always monetary, money side, substance over form. All right. Consistency concept requires that same methods, accounting policies, and estimation techniques are to be used consistently within the same period from one period to the next. Like, for example, depreciation is like, we charge like to motor vehicles, the wear and tear. You can use what they call straight line method. You just charge 10% of cost per year, something like that. Or you can use what they call the reducing balance method, like it's 10% of the net book value of the asset at the end of each year. But now you can't be changing from year to year now, these concepts. You need to be consistent. So that's the consistency concept. A separate determination concept, it states that each component of any category of assets or liabilities should be valued separately when arriving at a total to be shown in the accounts for that category. And then we have what they call the materiality concept. It assumes that only material items should be disclosed in financial statement. Material items, that means something you can value money-wise. These numbers, accounting. Information is material if its omission or a misstatement could influence the economic decisions of users taken on the basis of the financial statement. So that's the materiality concept. Now we jump onto the accounting equation. It's a mathematical function which underlies the entire accounting process. Like, once you have this equation in your head, you are now an accounting master. It becomes easy once you understand. Accounting equation is based on that dual aspect concept now. Remember, debit, credit. For every debit entry, there is an equal and corresponding credit entry. So the fundamental accounting equation is just assets are equal to liabilities plus equity. Like that. Assets are equal to liabilities plus equity. Assets, what you own. Liabilities, what you owe. Equity, what you owe the owners. Yes. So assets equals liabilities plus equity. You can write it in another form, substitution, basic mathematics. So now the equity, now I want you to look at it. The equity is equal to owner's capital minus owner's withdrawals. Like if the owner takes some money for personal use, and then plus revenues minus expense. Now revenues minus expense, that's already profit or loss. So you need to add there. It's all under equity. So you see revenues and expenses, those ones, they are in the statement of comprehensive income. That's where you get your profit. And then you in the balance sheet now, it's owner's capital minus owner's withdrawal plus profit, you get equity, or minus loss, you get equity. Otherwise, assets are equal to liabilities plus equity. That's the accounting equation. This is an example. Andrew, he began a business with $100,000. So equity goes up 100 because he's investing, he's beginning a business. That means he's putting capital, he's an owner, like shareholder. He puts 100,000. And now there is 100,000 cash. Cash is an asset. So you see on the debit, we have cash, asset. And on the credit, we have the equity capital, 100, up, it balances. And I want you to understand that assets always have a debit balance. And then capital and liabilities, they always have a credit balance. That's why the accounting equation, we can go back to it. You see assets on the left-hand side, that means the debit. And then liabilities plus equity, that's the credit side. That means they always have a credit balance. All right, so you saw the example of Andrew there. Then he purchased office equipment, 20,000. Office equipment, that's an asset. 20,000 up the assets. And the cash is going out because he's paying for the office equipment using cash. Cash is also an asset, it's going down. You see how it happens there, you can see. Yes, from the PowerPoint slide there. Yes, another example, like these examples, you just go through them, you can see them. Like you at your own personal time, you can pause the video, you go and you see. But all you need to remember is that there's always double entry. Like there is no transaction where you just enter one thing. No, there is always debit and credit. Okay. The financial statement preparation, this is the accounting process. Number one, collecting and analyzing documents, like those source documents, now receipts, invoices, this, and then once you get the transaction details from those source documents, you post to a journal. Once you post to a journal, you then post to the ledger account. Once you post to the ledger accounts and balance them off, you prepare the trial balance. Once you do the trial balance, if there are any adjustment entries, you take care of them, and then you end up with the adjusted trial balance. And after that, now you can start preparing the financial statements. And once you prepare them, you have the post-closing entries, like some things you want to note from the results now of those financial statements. And then you do now what they call the post-closing trial balance after the financial statements have been audited, finalized, and all that. And then the cycle begins again for the next financial period. So this is the financial statement preparation cycle, the accounting process. All right, guys, so welcome to the end of the chapter. Today we talked about accounting concepts and conventions. We also introduced the accounting equation with examples. Its assets is equal to capital plus liabilities, or equity plus liabilities. And we looked at the meta cycle of accounting, that process, the 9 stages, like how you prepare the financial statements from the start, how it starts from the source documents, posting to the journals, ledgers, balancing off, this. All right, and the key resource, Frank Wood, guys. Frank Wood Business Accounting 15th edition, and other materials there. Request your quiz from me, and you do your quiz and assignment. Once you pass those, we mint for you your module certificate on this chapter. Yeah, you can contact me on those details there. All right, guys. Chapter 4 now we start practical accounting. Here we're doing mostly theory. If you noticed, the first 3 lessons, it was mostly theory based. Theory. Now we are going practical, recording transactions. So this chapter is quite long. It's very long because I cover all the recordings of transactions in accounting in that chapter. So we are gonna do it at a all right, we'll jump into it. But for now, I want you to focus on these first 3 chapters. Go through them again, and make sure you get your quizzes and assignments and certificates. And once you are good with these ones, it's going to be much easier now when we start recording the transactions, because it will become automated in your head if you understand the concepts already. So take your time, guys. The first 3 chapters. Go through the materials, request if you need any tutorials, and if you are ready for your quiz and assignments, request I give you. You complete them in the time frame I give, you get your minted certificate, you prepare for